Something extraordinary is happening in the silver market right now, and if you're not paying attention, you're about to miss one of the most explosive moves we've seen in decades. I'm talking about a setup so tight, so compressed, that when it breaks, and it will break, the velocity is going to shock even seasoned traders. Let me show you exactly what I'm seeing, because this isn't speculation. This is pattern recognition based on market structure, supply dynamics, and institutional positioning that's creating a perfect storm. Right now, silver is trading in what technical analysts call an ascending channel squeeze. Picture a coiled spring being compressed tighter and tighter. That's exactly what's happening. The metal has been testing major resistance around the $53 to $54 zone repeatedly, and each time it touches that level, it's building more energy for the breakout. Here's what makes this different from every other consolidation pattern we've seen. The fundamentals underneath this technical setup are absolutely screaming. We're not just looking at a chart pattern in isolation. We're looking at a chart pattern sitting on top of the fifth consecutive year of structural supply deficits. Let me explain what that means in practical terms. The silver market has been consuming more silver than it produces for 5 straight years. That's not a temporary imbalance. That's a fundamental shift in market structure, and it's accelerating. The Silver Institute just released data showing that industrial demand is exploding across key technology sectors. We're talking about solar panels, electric vehicles, advanced electronics, 5G infrastructure. Every major growth sector of the global economy is silver intensive. And here's the kicker. This demand is price inelastic. Manufacturers can't just substitute silver out of these applications. It's the best conductor of electricity and heat. There's no replacement that performs as well. Solar panel production alone is consuming silver at unprecedented rates. Each panel requires about 20 grams of silver, and global solar installations are projected to double over the next 5 years. Electric vehicles use 2 to 3 times more silver than traditional combustion engine cars. The EV revolution isn't coming. It's here, and it's devouring silver supply. But here's where it gets really interesting. While industrial demand is surging, mine production is essentially flat. Silver isn't primarily mined for silver. About 70% of silver production comes as a byproduct of mining other metals: copper, lead, zinc, gold. So when copper prices are low or mining operations slow down for economic reasons, silver supply contracts even when silver prices are rising. We're in this bizarre situation where silver demand is exploding, supply is constrained, and yet the price has been consolidating in this tight range. Why? Because the paper market has been absorbing the pressure. The COMEX futures market, where silver is traded in massive quantities that dwarf physical supply, has been the release valve. But that release valve is starting to fail. Let me walk you through what's happening in the market structure that most people aren't seeing. Commercial traders, the big banks and institutions that traditionally short silver to hedge physical positions, have been reducing their short positions dramatically. This is crucial. When commercials cover shorts, it removes selling pressure from the market. At the same time, large speculators and managed money funds have been building long positions, but not at extreme levels yet. There's still massive room for momentum buying when this breaks out. The COMEX warehouse stocks tell an even more compelling story. Eligible silver, metal that's available for delivery, has been declining steadily. We're seeing drawdowns that indicate physical tightness, even while the paper price remains contained. This is exactly what happened before previous major silver rallies. The physical market starts disconnecting from the paper market, and eventually the paper market has to catch up to reality. Now let's talk about what's happening at the institutional level, because this is where the real money is positioning. Central banks globally have been on a gold buying spree, but smart money is watching the gold to silver ratio. Right now, that ratio is still historically elevated. Gold is trading at roughly 85 times the price of silver. Historically, that ratio has averaged around 60 to 65. When it reverts to mean, and it always does, silver either catches up to gold or gold comes down to silver. Given the macro environment, which direction do you think that's going? Investment demand is starting to wake up. Silver ETF holdings have been growing after a period of outflows. When retail investors and institutions start piling into silver ETFs, it creates real physical demand because those funds have to buy actual metal to back the shares. We're seeing the early stages of that flow reversing from outflows to inflows. Here's something most people don't understand about silver. It's both an industrial metal and a monetary metal. That dual nature creates unique dynamics. When the economy is strong, industrial demand drives prices. When there's monetary uncertainty, investment demand drives prices. Right now, we have both forces aligning: strong industrial demand from technology sectors and growing monetary uncertainty driving investment flows. The geopolitical backdrop is adding fuel to this fire. We're watching the early stages of a global monetary system shift. The BRICS nations are actively working to reduce dollar dependence. They're settling trade in local currencies, building alternative payment systems, and accumulating hard assets. Silver, like gold, benefits from this de-dollarization trend because it's a tangible store of value outside the fiat system. Think about what happened in the 1970s. The last time we saw a major monetary system shift, when Nixon closed the gold window and ended dollar convertibility to gold. Silver went from under $2 an ounce to $50 in less than a decade. That's a 25 times move. We're in the early innings of a similar systemic shift right now. But here's what makes this setup even more explosive than the 70s. Back then, silver was primarily a monetary metal with some industrial uses. Today, it's absolutely critical to the technology infrastructure of the modern economy. You can't build the green energy transition without silver. You can't manufacture electric vehicles without silver. You can't deploy 5G networks without silver. The industrial demand floor is exponentially higher than it was 50 years ago. Let me paint you a picture of what happens when this coil releases. We've seen this pattern before in other commodities. When a market is in structural deficit, trading in a tight range with declining available supply and building institutional interest, the breakout isn't gradual, it's violent. Look at what happened to palladium a few years ago. Similar setup: structural deficits, tight trading range, industrial demand, limited supply. When it broke out, it went from $800 to nearly $3,000 in less than 2 years. Silver has even more explosive potential because the market is larger, more liquid, and has both industrial and monetary demand drivers. The technical setup right now is textbook. We have an ascending channel with higher lows and higher highs. Each time silver tests that $54 resistance, it's building more energy. The volume patterns show accumulation. Smart money quietly building positions. The moving averages are aligning in a bullish configuration. The momentum indicators are coiling but not overbought, which means there's room to run when it breaks. Here's the key level everyone is watching: a confirmed close above $54. That's the trigger. Once silver breaks and holds above that level, the next resistance isn't until the 60s, and after that, there's not much standing in the way of a run to the previous all-time highs near $50. Wait, we're already above that. The previous peak was $49 back in 2011. We're in price discovery mode above that level. Now, I want to take a quick moment here because this is relevant for a lot of people watching. If you're sitting on retirement accounts, IRAs, 401ks, and you're concerned about monetary instability, inflation, or just want exposure to physical precious metals in a tax-advantaged way, I put together a free guide on how gold IRAs work. It covers the mechanics of getting physical gold or silver into your retirement account without triggering tax penalties. There's a link in the description if that's something you want to explore. No pressure, just information, if it's relevant to your situation. All right, back to where this price is headed and why the timing matters right now. The seasonal patterns for silver are also aligning. Historically, silver tends to perform well in the first quarter of the year. We're heading into that window. Combine seasonal tailwinds with this technical setup and these fundamental drivers, and you have a convergence of factors that rarely align all at once. But let's talk about the risks, because nothing is guaranteed in markets. What could derail this? A major deflationary shock could temporarily pressure silver. If the global economy suddenly collapsed and industrial demand evaporated, that would be bearish. But here's the thing. In that scenario, the monetary demand would likely surge as people flee to hard assets. Silver might dip initially, but would probably recover quickly. The other risk is a massive increase in supply. But that's not happening. Mining projects take years to develop. There's no flood of new silver supply coming online. Recycling can increase, but it's already factored into the supply equation and can't scale fast enough to meet the demand surge we're seeing. The more likely scenario is that we're about to see a repricing of silver that reflects its true supply-demand fundamentals. For years, the paper market has kept a lid on prices through unlimited paper contracts, but physical tightness is starting to matter. When buyers want actual metal and it's not readily available, premiums spike, and the paper price has to adjust. We're already seeing this in the retail market. Try to buy physical silver right now. Premiums over spot price are elevated. Delivery times are extended. Dealers are struggling to source inventory. That's not a sign of a market with abundant supply. That's a sign of a market under stress. The smart money sees this. That's why we're seeing accumulation in the options market. Call option volume has been increasing, with strikes at $60, $70, even $80. Traders are positioning for a major move higher, and they're willing to pay for that optionality because the risk-reward is so skewed to the upside. Think about the math here. If silver is at $53 and you believe it's going to 80 or 100, that's a 50 to 90% gain. But the downside? Even in a worst-case scenario, how much lower can it realistically go when we have structural deficits and surging industrial demand? Maybe back to 45 or 40? That's a 15% downside versus a 50 to 90% upside. That's the kind of asymmetric setup that sophisticated traders dream about. And we haven't even talked about the monetary policy backdrop. Central banks globally are in an impossible position. They've created so much debt that they can't afford to let interest rates stay high for long. When they inevitably pivot back to easier policy, and they will, because the debt burden demands it, that's rocket fuel for precious metals. Silver, in particular, benefits from this because it's more volatile than gold. When precious metals are in a bull market, silver typically outperforms gold by a factor of 2 or 3 to 1. If gold goes up 20%, silver might go up 40 or 60%. That leverage is why traders love silver during bull markets. The historical parallels are striking. In the 2008 financial crisis aftermath, silver went from $9 to $49 in less than 3 years. That's a 500% move. In the 1970s, as I mentioned, it went from under $2 to $50. Even in the mini bull market from 2015 to 2011, silver more than doubled. We're setting up for a similar move, but potentially larger because the fundamental drivers are stronger. The industrial demand base is higher. The supply constraints are tighter. The monetary system stress is greater, and the technical setup is more compressed. Here's what I'm watching for confirmation. First, that break above $54 with strong volume. Second, a retest of that level as support. We want to see 54 become the new floor, not the ceiling. Third, momentum indicators like RSI and MACD confirming the breakout with bullish crossovers. And fourth, increasing volume and open interest in the futures market, showing that new money is flowing in. When all 4 of those conditions are met, that's when the spring releases. And based on what I'm seeing in the market structure right now, we're very close. This could happen in days or weeks, not months. The beauty of this setup is that you don't need to be a genius to see it. The chart is clear. The fundamentals are clear. The institutional positioning is clear. Everything is aligning. The only question is timing, and even that's getting clearer as we approach these key technical levels. For traders, this is a high probability setup with defined risk. You can enter on the breakout with a stop below the recent lows, giving you a clear risk-reward ratio. For investors, this is an opportunity to add exposure to an asset that's fundamentally undervalued relative to its supply-demand dynamics and has massive upside potential. The silver market is telling us something right now. It's coiling, compressing, building energy. Every day that it holds this range, every test of resistance that doesn't break down, every piece of fundamental news about supply deficits and demand growth, it's all adding pressure to the spring. And when springs release, they don't do it slowly, they explode. That's what's coming in silver. The question isn't if, it's when. And based on everything I'm seeing, the technicals, the fundamentals, the positioning, the macro backdrop, that when is approaching fast. This is one of those moments in markets where everything aligns, where the chart, the fundamentals, and the macro environment all point in the same direction. Those moments are rare. When they happen, you pay attention. You position accordingly. And you prepare for the move. Silver is coiling for a massive spring. The explosion is coming. Make sure you're ready when it does.